Welcome to today's Explainer, everyone. I am so thrilled to have you here. Today, we're rolling up our sleeves and objectively unpacking the source materials surrounding Ericsson stock to see what the numbers actually reveal. We are completely stripping away the mainstream noise and getting right into the hard data, looking at the exact red and green flags that the financial media so often ignores. We've got a lot of fascinating ground to cover, so let's jump right in. Okay, let's dive right into this central mystery posed by our source. Is Ericsson stock a classic value trap, or is it a hidden gem that the market is just completely mispricing? Now, as of August 2026, Ericsson stock is trading right near $10.08, and it's actually up a very impressive 44% over the past year. On the surface, Wall Street seems to love the 5G narrative, but when you start to peel back the layers of our source material, you realize the underlying story is much more complicated. Just look at this massive shock from Q2 2026. Think about this for a second. Ericsson reported adjusted earnings per share of just over 12 cents. That is a staggering 89.4% miss compared to what Wall Street was forecasting, an almost 90% miss. Naturally, this caught absolutely everyone off guard and sent the stock tumbling in pre-market trading. So how do we make sense of this? Well, today we're acting as the jury. We're going to run through a structured investigative scorecard, unpacking that earnings cliff, digging into 5 glaring red flags, uncovering the hidden green flags, assessing their economic moat, running a valuation gauntlet, and finally delivering our verdict based on the evidence. All right, let's kick things off with that first piece of the puzzle, the massive earnings cliff. So despite the stock being up nearly 44% year over year, that brutal Q2 EPS drop didn't happen in a vacuum. Revenue missed expectations by a cool $250 million. And as an impartial explainer, I have to point out that this structural weakness at the top line is exactly what's fueling the bear case forming around the company right now. Which brings us directly to Exhibit A, the ugly truths and fundamental weaknesses. Our source material lays out 5 really persistent red flags. This isn't just a one-off bad quarter. First up, revenue is actually down 6% year over year. Second, their bread-and-butter network segment is seriously struggling. Third, management is waving warning flags about component cost inflation, driven largely by the AI boom. Fourth, we're looking at a literal earnings cliff, where the forward PE ratio is sitting higher than the trailing PE. That basically means the market expects future earnings to be worse than today's. And fifth, the analysts are terrified. Seriously, take a look at this level of Wall Street pessimism from July 2026. 0%. 0% of analysts rate this a strong buy. Meanwhile, almost 30% are screaming strong sell. You really don't see that kind of deep negativity very often. It absolutely makes you wonder what the institutional folks are seeing that the average retail investor might be missing. But hold on, we have to weigh both sides evenly. Let's pivot over to Exhibit B, the hidden positives that the mainstream media often totally ignores. Because despite that massive earnings pressure, Ericsson has some undeniably strong foundations. For starters, they have an iron grip on Western markets, especially with competitors like Huawei completely locked out by geopolitical tailwinds. Plus, they're sitting on over 60,000 granted patents. That translates to a 13.5 billion SEK annual run rate in pure, high-margin licensing revenue. Add in a rock-solid balance sheet with nearly 60 billion SEK in net cash, that's north of $6 billion US dollars, by the way, and a major upcoming leadership shift? Speaking of that shift, internal sentiment is actually incredibly optimistic. In June 2026, it was announced that Per Narvinger is taking the reins of CEO. And he's no outsider, right? He's a 30-year veteran of the company who led their massive networks business. Having a seasoned pro stepping up, our source sees this as a major green flag. It signals continuity, but also brings a fresh perspective to maybe optimize some costs and drive much-needed change. Next up, we need to evaluate their moat, the structural business advantage that legendary investors consider absolutely crucial. To understand the biggest threat to Ericsson's dominance, you have to understand Open RAN. Basically, it's a technology architecture that lets telecom operators mix and match hardware and software from totally different vendors. So instead of being forced to buy an entire proprietary system from just one company, operators suddenly have choices. Theoretically, this could totally destroy traditional vendor lock-in. And that creates this massive tension at the heart of the stock. On one hand, Ericsson's moat is built like a fortress. Massive switching costs, those 60,000 patents, and 45 billion SEK spent annually on R&D. But on the other hand, Open RAN is basically a siege engine parked right outside the gates. With huge players like AT&T actively pivoting toward Open RAN, Ericsson's traditional vendor lock-in is facing a very real existential threat. All right, time to bring in the heavy hitters. Let's run Ericsson through our valuation gauntlet. Let's see how they hold up against the frameworks of investing legends Benjamin Graham, Peter Lynch, and Warren Buffett. The data here is super telling. Graham, the father of value investing, he gives it a hard fail because the $10.08 price tag is more than double his conservative $4.42 Graham number. Growth master Peter Lynch, also a fail, thanks to a PEG ratio over 1 and that nasty 43% EPS decline in the first half of the year. And Buffett, he gives it a wait. Sure, he'd admire the patents and the tech leadership, but the valuation just doesn't justify the downward fundamental trends. And when we look a little closer, we can see exactly why Buffett would say wait. Remember, Buffett loves stable management, but our source highlights 3 major executive departures happening in rapid succession. The networks head stepped down in March 2025, global ops left in January 2026, and now the CEO is retiring in September 2026. For a structural value investor, 3 senior executives leaving this quickly is a pretty glaring yellow flag. Okay, we've laid out the charges, the green flags, the moat, and the expert frameworks. Let's synthesize all this into our final verdict. And here is where we hit a massive paradox. The value legends are saying no or wait at $10. Wall Street is screaming hold or sell. But a traditional discounted cash flow model actually implies a fair value of around $14. That's a potential 40% upside. But, and this is a literal deal breaker of a but, that $14 target only works if some highly optimistic bull case assumptions actually come true. If 5G spending doesn't recover, or if Open RAN eats into their margins, that model completely falls apart. Because of that wild uncertainty, the source firmly categorizes Ericsson as a watchlist stock. For it to become truly attractive to value investors, we'd probably need to see a 20 to 30% price drop. In the meantime, they urge investors to watch 3 specific metrics like a hawk. 1. Does the operating margin actually bottom out and recover? 2. What is the real-world adoption rate of that Open RAN threat? And 3, what strategic direction will the new CEO take moving forward? So based on everything we've unpacked in today's explainer, I want to leave you with this final vital thought to chew on. Is Open RAN going to ultimately dismantle Ericsson's historic moat, or is this tech giant going to adapt and easily navigate the threat? Weighing those glaring red flags against the hidden green gems, how do you judge the verdict? Thank you so much for joining me as we dug into this fascinating source material today. Stay curious, stay rational, and I'll catch you in the next explainer.